Joining us right now for more on the markets is Amy Wu Silverman. She's RBC Capital Markets head of derivative strategy. And Amy, it's been a little bit of a painful year if you've been busy trading options throughout the first half.
Yeah, that's right, Becky. So, one of the stats I like to share is year to date, when you just look at every option strategy that is available to you, owning hedges or selling puts or overwriting, you've actually been better off just owning the S&P, coming in around almost 15% relative to all the other option strategies, which have actually managed to underperform that this year.
I mean, that's a little disheartening. If you've been putting a lot of time in this, research into this, and thinking, wow, if I had done nothing, paid no attention, and just indexed it, I would have made more. Do you think that continues in the second half, or do you think things are shifting here?
Yeah, I'd say two things about that. That's interesting. The first is it hasn't stopped people from continuing to sell volatility to harvest that premium. And second, look, this is sort of a year-to-date number. However, last year there was substantial outperformance in option strategies. And so I think it really is coming to a point where we don't know what the second half looks like, especially given how well the outperformance has been year-to-date.
You point to Murphy's Law and how, Murphy's Law is whatever can go wrong will go wrong. What does Murphy's Law look like for investors in the second half?
Yeah, it's an interesting question. I always think about Murphy's Law sort of as a joke, but sort of not. If you think about what the pain trade was for investors this whole year, it's just been this rip up. We were certainly not positioned for it. I heard you guys talking a little bit earlier about the impending recession that has yet to happen. I think that was on everyone's minds. Everyone was so overwhelmingly bearish. I saw that in my own conversations with investors. And so Murphy's Law from here is just a rapid and hard sell-off in tech and overall a rapid rise in volatility. We're not positioned for that. We have realized volatility levels of the S&P going back 50 years near a historical low.
You think that's likely?
And so this is the question that we struggle with, which is, when option prices get this low, it doesn't necessarily mean it's time to buy. It's simply time to point out that we're really at bargain basement prices. Another stat I like to look at is it actually only costs you 40% of what it cost you exactly 1 year ago to buy the option prices on a low quality basket. So, these are names like a Carvana or a Peloton. They have negative free cash flow. They're highly levered. Those costs have really sunk. But what is that catalyst that gets it going? That's what we need in the options market. I don't know. Sometimes it could be a left tail. Sometimes it could be a black swan. Sometimes it could simply be earnings. I do think there are catalysts coming up, but there is nothing certainly priced as of now that says, hey, this is what takes us lower from here.
We're starting earnings season. Mostly we've seen financials, some of the insurance companies. You think it could get more interesting as we get to more of the tech companies?
I think it can, Becky, and I think part of that just comes from simply the weight. I know we're going through this special rebalance, but the reality is these are still ultimately extremely heavy weights. And if these stocks go, so the market goes. And you did see that the last few days with a Netflix and Tesla, part of the Magnificent Seven, but the really large heavyweights still have yet to come. And not only does that impact volatility levels, it also impacts correlation, which on an index level feeds into that price of options ultimately.